Greetings from your 401k investment advisor, Scott Campbell, with my quarterly market update for the fourth quarter of 2025. The bull market continued in U.S. stock or equity markets during the fourth quarter of 2025. Although equity markets experienced turbulence in November and December, snuffing out the traditional year-end Santa Claus rally, the total U.S. market was up 2.36% for the fourth quarter and up over 17% for the year. That's spectacular. Anytime markets are up over 8%, we're doing phenomenal. The stunner in 2025 was the performance of foreign markets, which usually and still long-term underperform U.S. markets. Nonetheless, 2025 was a banner year for foreign equity markets. U.S. bond performance for the fourth quarter was mixed. Short-term bonds were up 1.16%, intermediate-term bonds up a shade less than 1%, and long-term bonds were flat for the quarter. For the year, short terms produced a very nice return of 5.35%. Terrific performance for a very low risk investment. Intermediate term bonds were up 6.32% and long-term bonds up 6.62%. Also, very nice performance for conservative investments. In October, market performance was driven by the Mag 7 and AI. But nervousness surrounding AI created volatility in the markets in November and December. Nervousness surrounding AI comes from short-term traders who are concerned about stock valuations, that's the current value of a company's stock, on a daily basis. They're concerned at this moment AI companies aren't making enough money. You and I and everybody watching this are concerned about stock valuations in the long term. And we can all agree that AI is in its infancy. Kind of like back when the internet was in its infancy and some thought expectations were too high. Well, they were clearly wrong, and the AI skeptics will also be proven wrong. A very welcome trend appeared during the latter half of 2025 and continued throughout the end of the year. Market gains broadened beyond the Mag 7 tech stocks. Small caps and value stocks produced above average returns. Another piece of evidence, asset allocation is the best strategy. That is the idea of diversifying your investment mix to include different investment types. The economy continues to grow and at a faster pace than predicted earlier in the year. Preliminary data shows the real GDP growth of approximately 3% annualized for the fourth quarter. That's down from the third quarter, but the third quarter growth was record-setting. Interestingly, third quarter growth was initially calculated to be at 3.3% at the end of the quarter. The actual growth rate for the third quarter came in at 4.3%. We'll see what the actual growth rate is for the fourth quarter because the government shutdown delayed the collection and processing of a lot of data. Energy. Energy costs play a vital role in our economy. The cost of gas factors into most areas of the economy. The cost of most products and services include gas and oil. Consumers are tremendously affected by the cost of gas and oil. Lower energy prices provide relief to every consumer, especially those on the lower end of the income spectrum. 70% of our economy is based on consumer spending, so giving consumers more money is a very good thing for the economy. Crude oil prices dropped 20% in 2025. Crude oil was trading at $75 a barrel on January 1, 2025. At the end of the year, oil was down to $60 a barrel. And oil is expected to continue to drop in cost due to a global glut. This U.S. takeover of Venezuela will possibly increase oil prices in the short term because of supply interruptions. That's not a fact, that's just an anticipation. But longer term, oil prices will come down because U.S. refiners will benefit from the cheaper crude that comes out of the ground in Venezuela. And that will reduce their reliance on Canadian rail costs and Middle Eastern heavy grades. Inflation remains slightly higher than the Fed's target, but it's in check and shows signs of normalizing. Tariffs have not had the disastrous effect on inflation predicted by some. And the White House is talking about easing increases in tariffs to make sure that inflation is kept in check. The labor market showed weakness in hiring during the fourth quarter. The unemployment rate is historically low, but rose modestly in the fourth quarter, signaling a softening labor market. The Fed is expected to lower interest rates in 2026, especially with a new chairman of the Fed Reserve expected this month. Most experts expect the economy to continue to expand this year, and expectations for the stock market are also positive. So stay invested, reap the benefits. Please reach out if you have any questions or need any help. Thanks, and I hope to chat soon.